We went through 25, 30 years of globalization of trade and liberalization of finance. And that made everything look easy because essentially the signals were scrambled. Inflation ceased to become a really good barometer of whether an economy was in reality in an overheating situation. And then, as you said, when all of a sudden those crucial underpinning situations, globalization and liberalization of finance, have gone into reverse, central banks find themselves in a really difficult situation.
Welcome back to Breakout with Breakingviews, sponsored by PGIM. I'm Peter Fellas, I'm the global editor of Breakingviews, and I'm joined again in our last pre-summer recording by Felix Martin. Hi, Felix. Welcome back.
Very nice to be here again.
So, Felix, you've been writing for us this week about the quiet revolution that is getting underway in central banking and in monetary policy. But I think maybe before we get into that, there's a couple of interesting speeches and reports that have come out in the past week or so that you've been looking at. But before we get into that, maybe just describe for us to begin with, what's the problem? Like, why are we talking about having to change the way monetary policy is done?
The simple answer to that, of course, has been the surprise resurgence of inflation. We lived through a very long time when inflation was very well contained. People are wondering now about why exactly that was, but at the time we thought it was because central bankers had got the hang of hitting inflation targets, and since the mid-1990s, inflation targeting has been the operating framework for most central banks. And then that's all gone completely haywire in the last 3 years with a dramatic resurgence of inflation, double-digit levels across the advanced economies. And that, of course, is raising questions about central banking and monetary policy.
There's a debate going on about this. Obviously, in public, all the central bankers are still sticking to their targets, saying they're going to get inflation back to 2%. Everybody's sort of, kind of committed to maintaining central bank independence and all those things. But it seems from what you're saying, like there are at least some signs beginning to appear that people are recognizing that getting inflation back down to 2% might involve some costs which are not really acceptable.
That's true both within the traditional trade-off. The traditional trade-off really in traditional central banking models under an inflation targeting framework is between the control of inflation on the one hand and unemployment on the other. Everyone knows that there's a dilemma there, that controlling inflation will often result in higher unemployment. And that trade-off was well understood. And I think part of what's going on is questions are being raised about whether central banks have been explicit enough about that trade-off and whether they might want to tolerate somewhat higher inflation than their targets in order not to get too much unemployment. But there's a new dilemma as well. And that's the one between controlling inflation and financial stability. You mentioned some of the speeches that are important that have come along this week. One was by the IMF's Deputy Managing Director, Geeta Gopinath, ex-chief economist at the IMF, and she raised exactly this point. She put some uncomfortable truths, as she put it, to the assembled European central bankers there. And one of the foremost of those uncomfortable truths was the fact that this new dilemma between financial stability and controlling inflation, in other words, the dilemma is that raising interest rates in a way that would be sufficient to kill inflation might cause big problems for financial stability. She raised the fact that an uncomfortable truth is that that's going to be a real problem and that trade-off has to be thought about.
And obviously, we've seen some of these problems already, the pension fund blow up in the UK, Silicon Valley Bank in the US, and then I guess just this week, Thames Water, the UK's largest water utility, it appears struggling with heavy debts. But I guess the other thing, that question that raised by that analysis, which you raised as well, is sort of, well, how did we get into this situation where we've got this huge financial system that is posing these problems and causing these constraints? That's
exactly right. The dimensions of this trade-off, the financial stability trade-off, have become really big. It's not just again the traditional one between problems that might arise in the banking system. Those you might think could be relatively easily solved. Central banks can get liquidity to banks when things go wrong. Even in the non-bank financial sector, so for example, pension funds, insurance funds, and so on, we saw actually in October last year, the central bank could be pretty efficient at getting help to those. The problem these days is that we potentially face, in a very, very financialized economy, problems for corporate borrowers. You gave the example there of Thames Water in the UK, very heavily levered up company, as many companies are after 15 years of low interest rates. And also, of course, households. In the UK here, there's the whole problem been much in the news of mortgage holders. And those are things it's much more difficult to see how central banks would deal with them. Now, you posed the question, how did we end up in this situation? And the other important report, which has come out last week, is the annual report of the Bank for International Settlements. And it gives a very nice historic view answering exactly that question.
So the argument essentially seems to be we had globalization, kind of it removed a lot of constraints in terms of supply for the developed economy. And so it was possible for governments and central banks to basically let demand kind of build up without having to worry too much about inflation. And that then created this whole system. Of course, what's happened in the last couple of years, as you point out, is that we've had the US is sort of in a standoff trade war with Russia, with China. We've had COVID, which has upended all these supply chains, and then also the Russian invasion of Ukraine. So the sort of we've been through a period of loosening supply constraints, and now those supply constraints are coming roaring back.
I think this is actually becoming a sort of consensus in central banking circles. Christine Lagarde made exactly the same point back in April. The idea is that we went through 25, 30 years of globalization of trade and liberalization of finance, and that made everything look easy. It made it look easy because essentially the signals were scrambled. Inflation ceased to become a really good barometer of whether an economy was in reality in an overheating situation. And then, as you said, when all of a sudden those crucial underpinning situations, globalization and liberalization of finance, have gone into reverse, central banks find themselves in a really difficult situation. The BIS puts it like this. It says, we've got this ugly combination of the kind of high inflation that we used to have pre-1990, along with all the accumulated financial fragility of the post-1990 period. So that's a really difficult place to be.
So just then to bring it all to a conclusion, what does that mean for what happens to sort of central bank policy, and what does it mean for investors?
The cash value for investors is this. Listen to Gopinath. She is saying out loud that it may be better to tolerate higher inflation in order to safeguard financial viability. I think that's something it would be wise to bet on, even in the short term. But then look at what the BIS is saying, and you think, well, maybe there is some more serious retooling of monetary policy frameworks which need to happen, because the implications of the BIS analysis are that inflation targeting itself may be part of the problem. It's not necessarily the right target for monetary policy. Perhaps it would be better to foreground financial stability concerns directly. And then there's even the question about the independence of central banks, because bizarrely enough, and another implication of their analysis is that actually the feedback mechanism appeared to work better in the days when central banks weren't independent. Now, these things I don't think are going to happen immediately, and the BIS wasn't drawing these conclusions absolutely explicitly, but we live in strange times. And I think it would be wise not to be complacent. Lots of odd revolutions are taking place. So investors might want to keep that just in the back of their minds.
Thanks, Felix, as always. Lots to ponder over the summer. Breakout, we're going to take a bit of a break, and then we'll be back again in the autumn with more editions of Breakout.
We look forward to it.